For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. Then we'll talk about the state of the economy and what to expect in the months and the years ahead, which will also include artificial intelligence. And then finally, how to handle risk in retirement. My name's Jeff Shade, and as always, I'm just here to ask the questions with the words of wisdom and solid advice. They come from Jake Floyd of Floyd Financial Group. Hey, Jake, how you doing today?
I'm doing great, Jeff. Thanks for asking.
Certainly. Welcome, my friend. I hope everybody listening to the radio program is having a great weekend, a great August. The dog days of August are here. I don't know why they call it the dog days of August, Jake. I think we need Randy to answer that question.
I'm sure that he would know.
He knows just about everything, too. But anyway, dog days of August, usually hot and humid, and then we're going to head into my favorite part of the year, which is going to be fall. Anyways, I said, hope everybody's having a great weekend. We've got a lot to talk about today. Chair Powell is still on the hot seat. Jake, Donald Trump has called him numbskull, Mr. Too Late and Major Loser. I don't think I've ever heard a president describe somebody like that. It is quite evident that Donald Trump is not happy with Jerome Powell, and I would expect that a lot of other people listening may not be happy with him as well, too. So what do you want to say about Jerome Powell in his most recent meeting?
Yeah, so I think that Jerome Powell and the FOMC committee, are really concerned that they're going to cut rates too far too soon and reignite inflation. I do think that that is not something they should be that worried about with AI coming in to create deflation. We'll talk about that over the next 20 minutes or so. But to answer the question directly, I do think that basically they didn't change rates, which I was pretty well expecting. There's a few people thinking that maybe they were going to cut rates. That was kind of not a big piece of news that they didn't cut. However, him pouring cold water on the idea of cutting in September was kind of big news. And the market didn't like that very much. And then on Thursday last week and Friday last week, the market proceeded to go down some more on some of the jobs numbers. And ultimately, I really think rates are going to come down in a big way. The question is, are we going to do it in time to where we don't have some kind of recession, or are we going to wait for the recession and then do it? And I think that's Trump's frustration, is he can see the jobs market cracking, not necessarily in a bad way, but it's simply been propped up artificially by all the money that we've printed here. And we don't need to keep a restrictive policy any longer the way we are right now. And so we've talked about this in the past on the show, but right now the federal funds rate is 4.25 to 4.50, meaning 4.25% to 4.5%, which is probably about 1.5% above neutral. Okay, so neutral interest rate policy means it's not helping and it's not hurting the economy to have the interest rate policy there. So right now we're driving around with the emergency brake on, is kind of what we're doing in the economy. And the economy is still doing well, even in that environment. Most of the government and the numbers people and the FOMC and Jerome Powell himself are totally discounting the deflationary effect that AI is going to have. For the last 5 to 6 years, we have seen employers competing for employees. There's not enough people to do a lot of the jobs. If you want to have work done on your house, or if you've tried to have work done on your house in the last couple of years, you'll know that everybody's booked out 6, 8, 10 weeks if they're worth their salt. If they're not, you better watch out because they may not show up or they may take your stuff while you're there. Mm-hmm. There's a severe shortage of laborers out there, or at least has been for the last 5 or 6 years. As AI becomes more and more a thing, and we're seeing it almost every day in corporate news where, Microsoft lays off 9,000 people, so-and-so lays off another 10,000 people, so-and-so lays off 4,000 people. And we're starting to see where at this point, it's not actually eliminating too many people's jobs. It's really more eliminating the available positions that people have been trying to fill. So we're seeing the beginnings of the tightening of the labor market the other way. And so where we have been in a situation where employers are competing for employees, we're about to see a situation where employees are competing for jobs. And when that starts to happen, that will bring wages down in a lot of areas. And as that happens, that creates deflation. I know Trump sees this and other people see this, but Jerome Powell does not seem to see this. And if we wait until that hits us to lower interest rates, we probably will have some kind of recession. Now, that being said, there's lots and lots of things to be positive about. It's totally possible to have a recession and have it not look like 2008, right? I think most people, when we think of recession, we think of the 2008 financial crisis. That's not the kind of recession I'm talking about. But we do need to get interest rates at least back down to neutral, maybe around 2.75 to 3%. If we wait for recession to hit, then interest rates will have to go back to zero, most likely, in order to combat this, especially as AI starts to take over jobs. In the next segment, we're going to talk about what that will look like, where we have AI eliminating jobs, deflation, while corporate profits soar. And that's an interesting thing to look at. But to answer your question, yes, Jerome Powell stood pat, if you will, on interest rates and kind of stiffened his upper lip and said, well, we may do it again in September. Now, so far, we've seen the Fed Watch, right, which is a tool that we watch to show what people investing money are thinking is going to have happen in September. And so right after Powell's speech, there was about a 40% chance of a cut and a 60% chance they would stay. However, after the jobs numbers on Friday, it is now a 90% chance of a cut. That doesn't mean necessarily that he's going to cut, but so far, the Fed Watch numbers on the morning of the meeting have been exactly what Jerome Powell has done for the last 4 or 5 straight years. So that's a pretty good indicator of what's going on. I think there's a very high chance of a cut in September, but don't expect everybody to cheer it in necessarily. You know, a lot of people are like, well, if we cut, then the market's going to go up. Well, it depends on how much is already priced into the market. And so that's another set of issues that we'll have to deal with if and when they get here. And we'll also have to remember that that'll be in the middle of September, right? And September, seasonality-wise, is not a great month.
And Donald Trump, certainly it's been no secret that he's unhappy with Fed Chair Jerome Powell. Obviously, he's called him a few names there. He would like him to get out of the office, but Powell's term runs through May 15th of 2026, and he's made clear that he does not intend to resign early. Is it possible that Trump could name a successor earlier and maybe create a so-called shadow chair to diminish Powell's influence and go ahead and have a rate cut? Or is Fed Chair Powell just in charge until he's not in charge?
No, I would say there's a 90% chance of that happening where he appoints somebody ahead of time. I mean, it could even be very soon. And he talked about that actually, I think it was Tuesday morning of last week. He was on CNBC talking about that, and he said, I'm going to announce somebody very soon. So we'll see what happens, but you know, he wants to maintain pressure on Powell. It's very easy for him to declare victory after Powell is out then, you know, for him to take a victory lap. Everything Trump is doing is he wants to make himself look good, right?
Right.
And that doesn't mean that it's unjustified. I mean, I think a lot of things he's doing is good, but he is very concerned about optics. You know, he was in entertainment business. He's an entertainer. He's also an experience creator, right, through his hotels and things. So he has a very big tilt toward optics. He wants things to look a certain way. He wants his presidency to be viewed as the best ever. But, you know, he's always positioning the country and himself to come out smelling like a rose, as my grandpa would say. And I do think that's likely to happen.
Talking with Jake Floyd, Floyd Financial Group. We're talking about current events and in particular Fed Chair Powell cutting the interest rates. This is the 4th time that he's not done that. We'll have to wait and see what happens. Again, our phone number 417-889-7233. If you'd like to come in and sit down and talk with Jake about how these interest rates would affect you and your journey towards a confident retirement, no cost, no obligation for this consultation. It's a casual conversation. Again, you can talk about pretty much anything you want to talk about as far as retirement goes. You've got a friend in the financial services business, and we'd love to talk to you at 417-889-7233. You mentioned jobs report a few minutes ago. Jake, what is the long and short of the jobs report most recently?
Yeah, so in the jobs report, it's showing 2 things. Number one, the jobs market is slowing a little bit. We're starting to see the release of tension of employers fighting for employees. We're not yet really seeing, you know, a loose labor market yet, but we are starting to see the beginnings of what could become that. And as every month and every quarter goes by, the previous month and quarter's numbers keep getting revised downward, which means that, like many of us suspected, and as I said on this show a year ago, Biden is cooking the books, right? He's making it seem like the jobs market is better than it is. They're overstating the numbers and then revising it 2 or 3 months later when nobody's noticing. And Trump called that out on the CNBC interview too. And he said, basically all these numbers are rigged to try to get him reelected. And I do think that that's true. So we're starting to see that the labor market was not as strong last year as it seemed. And all this really plays right into the hands of the Fed cutting rates, right? Because the Fed has 2 mandates. The Fed wants maximum employment and price stability. So they're worried about inflation. They're worried about the jobs market. So if the jobs market starts to crack, they will start cutting rates. And the thing is most monetary policy has, in the words of Jerome Powell, long and variable lags, which simply means that any action that they take is going to take 5, 6, 8, 10, 12 months to take effect. It's not going to be like tomorrow it fixes it. And so knowing that, I'm kind of in agreement with Trump on this, that we should be cutting now because it's going to be too late by the time they actually start doing it. We probably should have been cutting a couple of months ago. And so we may have a little bit of consequences to those actions. But it'll be interesting to see if all the good things happening outweigh the bad things happening from an economic standpoint and a spending standpoint and a just overall economic prosperity standpoint.
Jake, let's switch gears and talk about tariffs. On the last day of July, President Trump signed a new tariff order. Can you explain a little bit about what's in that order?
Yeah, so the order was mainly to enact tariffs that had previously been paused for, it was 90 days, and then it got extended another month or so. And so a lot of these tariffs that had been promised that hadn't been put in went in as a result of this order. A lot of them are baseline 10%. As he announced, he has other ones that are at 15%, some at 25%, some at 35%. And he's been very vocal about which countries he'd like to see come further. The EU specifically has promised like $600 billion in investment, and a lot of these other countries have too. So it'll be interesting to see how well he can hold their feet to the fire. He's convinced that it's a done deal. I wish I had that much faith in the EU to do what they promised to do, or any other country for that matter. Again, I think there's a lot of people that like to criticize Trump, but man, I mean, if you look at the things he's doing, and yeah, he's got a big ego. So what? Like, if you look at what he's actually doing, it's very hard to argue with. He's doing so many things that people said, oh, you'll never get them to pay their fair share of NATO. Well, now we're paying 150% more than what it was before. And he's holding their feet to the fire. Oh, you'll never get these guys to pay tariffs. They're begging him for a 15% tariff instead of 50% and giving him $600 billion of investment, opening new markets. I mean, Japan, you haven't been able to sell anything in Japan unless you're Japanese for 100 years, and now he's getting Ford is going to be able to sell Ford F-150s there. We're going to be selling rice to Japan. Okay. I mean, that's like, selling ice to an Eskimo.
Yeah,
right?
I was going to say that.
So, I mean, that's just crazy. And he's doing it, and these guys are thanking him for it. People are like, oh, they'll never do that. Well, you don't know if you don't ask. Mm-hmm. If you never ask, you certainly won't receive. And this country has made a policy of giving itself away for so long. It's good to see it go the other way for a little while. And so, yeah, the reciprocal tariff order is mainly enacting a lot of those paused tariffs. We've seen some more rhetoric around Mexico getting repaused. I think Mexico, Canada, and China may take even later in the year to get done. They have some kind of temporary pauses going on here and there, and they say they're making progress. We'll see what happens. But, I mean, he set an expectation of China. He's hoping for, having a deal before the end of the year now. So that's obviously quite a ways out. I think what he wants to do is kind of sweep the rhetoric under the rug here a little bit and start focusing on other things instead of just the tariffs. At least that's how it feels as he shifts the focus.
Jake, I want to continue this conversation here in just a minute by talking about the state of the economy, what to expect in the months and the years ahead. But for right now, I want to take a quick moment to remind our listeners that you're hearing the program today. You're listening to Jake. You've listened to Jake and Randy for all of these years. It's finally time for you to address your retirement questions. You can do that by calling 417-889-7233. You can do it right now if you want. Leave your name, telephone number, Ashley will call you back. She'll set you up with an appointment with Jake or Randy or both so that you can ask the questions that you need the answers to about your retirement. Again, there's no cost, there's no obligation. This is just a casual conversation. We like to call it a no-tie zone here at Floyd Financial Group. You've got a friend in the financial services industry, and we would love to talk to you. So if you'd like some help with getting some questions answered, 417-889-7233, totally complimentary. You can also find out more about us online at floydfinancialgroup.com. Jake, let's take that break. When we come back, we'll continue to talk about current events and, in particular, market conditions, where we're going later on this year and in the years to come when Show Me the Money continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to continue talking about the state of the economy, artificial intelligence, and what to expect over the next, let's say, 2 to 10 years.
And Jake, that is a big question. Everybody wants to know, certainly not only what's happening today, but what can we expect in the future? Now, we've mentioned before that we do not have a crystal ball. A couple of years ago, I sent your dad, Randy, a crystal ball. Unfortunately, it did not work. He's gazed into it, and he's never gotten a definitive answer as to what's going to happen. So basically, we're forming an opinion on the information that we have right now. That information could change, so keep that in mind. This is just a prognostication, our best educated guess, if you will. So as far as the market goes, as far as the economy goes, let's first focus on the rest of this year, the rest of 2025. Based on the information that you have, Jake, what are you seeing in the cards or in the stars, so to speak?
Yeah, so I think the growing question is going to be, especially after what we talked about last segment about Jerome Powell and interest rates and the jobs market, is what's going to happen when we have a shrinking jobs market, but we have increasing profits in corporations. Because usually those things both go one direction or the other together. They don't go opposite directions. I would say this is a very unprecedented moment where we're going to see people having less money, but corporations still making more money and prices coming down. I don't think we'll have a lot of affordability issues, but the question is what's going to happen when those two forces are opposing each other? And what I come up with after thinking a lot about it is I think it's going to pay big time to be invested over the next 2 to 10 years or so. Meaning, if you are working and you do not have money to invest, your life may be difficult for the next little bit, because if you're working, let's say, a blue-collar job or a job that, a middle-class analyst type job or a copywriter, or you're a phone operator or something like that, you very well could be displaced by artificial intelligence or by somebody utilizing artificial intelligence just simply being more efficient, right? Maybe one person does the work of 4 people instead of just the one person. However, the people who are invested will be invested in either real estate or the stock market or whatever it may be. And as that happens, I think you're going to see corporate profits are going to spike because they're replacing a $40,000 a year employee with a $30 a month subscription to some AI chatbot or something. And so they're just pocketing all that money. That's what's going to drive prices down, because they won't have to have prices as high because they're making more money. But it's also going to drive the stock market, I believe, very strongly, that we could have a 1980s type stock market here for the next 10 years. And it's going to be a wild time to be alive, because AI is going to radically change the way the world looks. It's going to change how many hours you work in a week. My dad, has worked 50, 60, 70 hours a week for his entire career. And growing in popularity is a shorter work week, right? Instead of putting people out of work, what if everybody just works less? Again, I'm not sure how I feel about that personally just yet. I haven't formulated my opinion. But we are going to have to take steps if we start eliminating 10, 15% of the jobs in this country. And again, I'm not saying I agree with this, but we will either give those people money or find a way to have them earn it, right? By reducing work weeks, things like that. It's going to be a very interesting time looking forward. But I think the people who are going to come out ahead are the people who have money invested, either in the stock market, maybe in real estate. Gold is going to be another one that's very interesting because gold typically does very well in inflationary environments. Well, that ain't what we're going to have. We're going to have a deflationary environment. So gold should get crushed, honestly. I'm not ready to say that that's definitely going to happen because there's still a lot of fear and things out there, and gold gets, a premium for fear. But I think it's going to make it difficult for gold to go to some of these extreme highs that a lot of people are calling for, like, 7,000, 10,000 an ounce, that kind of thing. I think you're going to run out of money to put in there. And the reason why gold thrives on inflation is if the dollar is worth less, then it just simply takes more dollars to buy an ounce of gold. Therefore, the price goes up, right? If you have the opposite happening, where your dollar starts to go further again, that should mean that gold comes down, or at least has a big headwind to going up further. So I like real estate a lot because interest rates are likely to come down, maybe way back down, depending on how it happens. So that'll be good for the housing market. It'll be good for commercial real estate. And it'll be good for the stock market. It'll be good for the bond market in the short term, but after interest rates come down, then bonds are kind of back to picking up nickels in front of the freight train.
I like
For
that.
now, bonds look okay, but if interest rates do come way back down, then we'll need a bond alternative at that point. Maybe some type of annuity or some way to curb risk without making zero return, right? So it's going to be an interesting dichotomy to watch. First of all, we haven't seen deflation in this country other than a very short period of time during like the financial crisis in a very long time. So what usually is happening, though, is the economy is crashing. I don't think the economy is going to be crashing, but prices may still come down. And it should lead to a very prosperous time for people who are investing, but it could be harder for people who are not investing.
And Jake, a couple of things piqued my interest there. You talked about gold currently about $3,350 an ounce, forecast around $3,500, but that could be the high. And when you talk about real estate right now, interest rates for buying a home, 6.6, 6.7%. But if I'm hearing you correctly, Jake, you're saying they could go down into the fives, but are you thinking that they could go even lower than that in the near future?
If the AI revolution happens the way I think it will happen, I think you could see interest rates even back down to zero, where you have, 30-year mortgages in the fours and things like that. Whether they'll go back down into the threes, I'm not sure, but I think you could conceivably see them in the fours again. Now, again, that's not a guarantee. This is one guy's opinion, right?
Right.
But I do spend a lot of time thinking about this, and it's obviously my job to think about this as a money manager, as a financial advisor, not necessarily to prognosticate the future, but to identify risks that are coming down the pike at us and trying to protect people from them or utilize some of this information as strength to help make people money. So it doesn't make me right. I'm just simply saying I think it's going to get weird over the next 10 years or so. It's going to be very different from the last 60.
And the housing market is a big part of the economy. That's why we usually talk about this. Talking with Jake Floyd, Floyd Financial Group, talk about the market and the economy here for the coming next few months of this year. Also into next year, our phone number, 417-889-7233. If you'd like to get in and sit down and talk with Jake about his ideas about what's coming up here and how to position yourself insofar as growing your wealth and getting invested, staying invested, and getting retired and staying retired. You talked about being invested, Jake. You had mentioned real estate, but if you're looking to invest here for the next 5 to 10 years, I know you said that AI is going to create profits for all types of companies, but are there sectors that you might want to look into more than another?
That's a great question, Jeff. I spent a lot of time thinking about which companies will stand to benefit the most from this revolution. And you have your obvious answers like companies like NVIDIA, who have already realized humongous gains. And I think there's still some meat left on the bone there. I don't think they're done, but the people making the chips and things like that are obvious. And a little bit less obvious, but still pretty obvious, is as AI becomes more and more a factor, then cybersecurity is going to become more and more a problem, right? So any company that deals with that is likely going to get showered with capital to try to fix that problem. The more under the radar ones, I think, are companies that are embracing artificial intelligence to make their processes more streamlined, to build moats around their business so competitors can't compete. So I think Walmart's a good example of that. I think to an extent McDonald's is a good example of that. Again, I'm not saying everybody should go eat McDonald's, just simply saying that they are going to likely be one of those to use AI to create an environment where other businesses can't compete with them. So I think Walmart is definitely a big one that fits that bill. just as an example. And so what I'm thinking about is which companies are the sleeping companies? Which ones are the ones that nobody's really looking at toward AI, but are going to be a big beneficiary of AI? So a good example, I think, would be a customer service oriented company that has like a lot of phone traffic, right? People don't like phone systems right now because they suck, right? If you call into a phone system and it doesn't understand what you want, it's very frustrating. However, if you call into a phone system and it clearly speaks English and it knows what you want and can anticipate what you're going to ask and shorten the process and make it a pleasurable process, you're going to start to prefer the AI over the people. And I think there's some people kind of tilting their head when I say that, going, I don't know. Trust me, when it's good, you will get tired of real people messing it up. And that is the danger of AI, is people will start to embrace it because of its efficiency. And they'll just kind of start to throw the traditional customer service out. Now, I do think that somewhere down the road, that'll become the differentiating factor again. You know, if everybody's on AI, then somebody with actual personal customer service and a handshake and eye contact will become a differentiator. It's really about offloading jobs. It's about who can cut their head count by 20, 30% as employees, getting rid of 20, 30% of their employees. Those are the companies that are going to make bank. And so that's one of the things that I spend a lot of time thinking about, is trying to get ahead of that. And there's going to be some companies that just get left in the dust because they refuse to change, or just the nature of their business will become obsolete. And so we want to be careful about those companies as well.
And to your comment about the phone trees, Jake, I don't know if I'm alone in this sentiment, but I would be willing to pay $1 more for whatever I'm buying in order to have a person who picks up the phone and says, thank you for calling so-and-so company. My name is Jake. How can I help you today, in standard American English?
And I totally agree with that. What I'm saying is imagine the best customer service on the phone that you've ever had, and then take it up 200%. And AI will be capable of that in the not too distant future. You'll pick up the phone, and instead of it having a phone tree, the AI will just answer the phone and say, hey, how's it going? How can I help you? And then you just start talking, and it just starts talking back to you. And it feels like a person, except it's never disrespectful. It's never annoyed. It's never on its phone texting somebody instead of listening to you. Number one, I totally agree with what you said. I would 100% pay more. In fact, like the self-checkout thing drives me insane. So I totally agree with all that. I'm just simply saying that it's going to get good enough where you will start requesting it. And when that happens, there's going to be a lot of people that get put out of work. And the question is, what happens to those people? How do we fix that problem? And is that the detriment of those employees enough to offset the increased profits of these companies? And again, understand that I'm not looking at this as a philosophical standpoint. I'm simply talking about money here, so don't think I'm calloused. I'm simply saying that I think the markets are going to explode upwards over the next 10 years. And I think that the housing market will also be beneficiary of that. And I think that being invested over the next 10 years is going to be very important.
Well, here's my comment to these AI creators who may get into the phone answering business. If you would please train your AI to speak standard American English. Do not do it with a Philippine or an Indian accent that you cannot understand. And do not have it reading from a script. It drives me absolutely crazy. There are call centers overseas. You finally get to them and they're reading a script. They don't know what you're talking about. And I'm sure that everybody listening to the program today, or most people, are shaking their heads, yes, yes, yes. This is just absolutely out of control. So as I said, I'd pay $1 more for it right now. Talking with Jake Floyd of Floyd Financial Group. Jake, just a few more minutes left in this particular segment. We talked about what's happening for the next few months here of 2025. What do you see for the next decade? I like the idea of a return to the 80s type of thing.
Yeah, I mean, again, it's very difficult to predict because there's just never been anything quite like this that's happened before. But I know that markets are efficient and they're going to try to make money. You can count on Wall Street to be greedy. You can count on Congress to be self-interested. And while those things are not necessarily good things, it does tell us about what Wall Street's going to try to do with this revolution. And I think we're already seeing it. Again, if you look at some of these companies like Microsoft laid off 9,000 people and their stock went up 20% over the next 3 weeks. And it's a huge company. I mean, it added something like $500 billion in market cap. And these jobs they're eliminating are not like $30,000 a year jobs. I'd imagine the average cost, and again, I don't have those numbers in front of me, so don't quote me on this, but knowing what they're paying their people, in the kind of jobs that they were eliminating, it's probably an average of $350,000 a year per job. I mean, that's a humongous cost savings per year, every year looking forward. And so that money drops to the bottom line and the stock goes up. So I think that's really what's going to happen. I think it's going to leave a lot of people scratching their heads because there's going to be inequality. I mean, people think there's inequality now. It's going to get outrageous. It's going to be the haves and the have-nots. Ultimately, I imagine the government will step in to kind of redistribute some of that, whether you like that or not. And again, I'm not saying that I like it necessarily, but I do think that it's going to get to the point where you're going to have Elon be a trillionaire and those types of people in the not too distant future. And there will be probably some form of universal basic income that comes in, which will also drive stock markets to the moon. And so I think if there's one takeaway from here is AI is a little scary, but be invested.
And I long for the 80s. You know, I had a thick head of hair. I was a young fellow. I had a brand new 82 Honda Civic. I was a kid. I didn't have a lot to worry about. We're not going to be able to bring any of that back, but I am looking for an 80s type economy. Where are we going to find a new Ronnie Reagan? That's my question. I don't know about that, but we could use Ronald Reagan right now. Talking with Jake Floyd, Floyd Financial Group. 417-889-7233 is our telephone number. If you'd like to get in and sit down and talk with Jake about your journey towards a confident retirement. No questions off limits, no cost, no obligation, no judgment. We'll meet you where you are. Make that call right now at 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, let's take a break. When we come back here on Show Me the Money, we're going to be talking about actions to consider with your IRA now in the month of August, when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shane.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about actions you can take now for your IRA in retirement.
And Jake, we're heading into the dog days of summer, but when it comes to your retirement savings, August is actually a prime time to ask. So let's get right to it. A lot of people think IRA planning is something that you deal with in December, Jake, or even next April. But why should we start thinking about IRA moves right here in August?
There's quite a few reasons, Jeff, but I think probably the one that I agree with the most is that if you fund in August, that means that you're already ready to go and invested for November, December, January, which is historically some of the best months in the market, right? And so if we wait until December to get in, we've already missed some of the market moves. So if you're thinking about contributing to your IRA, now could be a good time to look at that.
So, Jake, let's talk specifics here. What's the first thing that IRAs should consider doing right now here in the month of August?
Yeah, so if you're not sure how you want to fund or what you want to fund to an IRA, one of the things that I like to look at is people's overall income. If we want to reduce your overall income by funding an IRA, or if you're trying to decide whether you want to fund a traditional IRA or a Roth IRA, a lot of what I look at is gross income or net income, because the average person is pretty close to the bubble if they're a two-income household, where they go from 12% to the Fed in taxes to 22%. That threshold right now is about $126,000 gross income. So if you're close to that, or if you're slightly over that, funding an IRA could potentially be saving you 22% to the Fed and 5% to the state. It's 27 cents on the dollar that you're saving now by using a regular IRA. If your income is significantly under that, you may want to fund a Roth to help protect against future tax raises. But that's really a little bit more preference, and we're kind of guessing at what the future of taxation is going to be. I have to say I'm a little bit biased to saving money in the now. I think a bird in the hand is worth probably half a dozen in the bush, and nobody's guaranteed tomorrow. And so any dollar I don't have to pay to the government, I don't want to. I want to pay my fair share. I don't want to do anything underhanded, but short of that, as long as it's allowed, I want to maximize all my deductions and pay as little to the government as possible.
And Jake, it goes without saying that the earlier you invest, the more time that your money has to grow. If you're 50 or older this year, don't forget you can contribute up to $8,000 into your IRA. You mentioned Roth conversions, and I think the long and short of it was that you should act now rather than wait.
So converting to a Roth is a much bigger question, and there's a lot of calculation that goes into that includes your other income, how much you're looking to convert, how old you are, how long till you have RMDs, your kids' income. There's a lot of things that factor into that. So I don't want to give anything blanket on the air here about Roth conversion. I was just really talking about funding a traditional IRA or funding a Roth IRA. Those are some of the things to consider. But again, doing these things in August, September, October, as opposed to November and December could potentially help you capture some gains later in the year.
Let's talk about RMDs a bit, Jake. Required minimum distributions. What is the deadline for taking your RMDs, and would it be better to take them now in August versus later?
Yeah, so that kind of depends a little bit on your view of markets. It also depends on whether this is your first year to take, or if this is, as far as RMD, if you just aged in, you're 73, or if you've already been taking RMDs for several years. If it were me right now, I would probably delay taking RMDs because I want that money to stay in there and keep working for us, because I think the end of the year from here will be higher than we are right now. Again, that's an educated guess. That's not a fact for sure. But if it was my money, I would probably want to leave it in and try to do my RMD in November or December toward the end of the year, assuming I'm a repeat RMDer. If this is my first year, I might even consider waiting a little bit more, because depending on how you take your first RMD could potentially make you have to take two in the same year down the road. Depending on your income, that may or may not be a good thing. But I would just say that I think we have good days ahead of us in the next 6 months, the next year, 2 years, and I want that money in there working for me as long as possible.
Jake, if you do not need the money, the RMD money, what is the alternative? What's something else that we could do with that money that might help us with taxes?
Yeah, so there's a couple things. One that really helps you with taxes is the QCD, which is a qualified charitable distribution. And what that does is, assuming you don't have enough deductions to itemize, which most people in retirement do not, the QCD allows you to kind of go around the 1099 of taking your RMD. So you can take your RMD, send it to a 501c3 charitable organization, so like your church, for example. I have a lot of people that tithe, that convert what they normally tithe out of their income. They start tithing out of their IRA so that they can save the tax money on the RMD. That's a big one. And so that money goes directly to them, and it never shows up to the IRS, and that's allowed by the tax law. So QCD is a big one. If you're not going to give the money away, or you're not tithing and that kind of thing, or you're already tithing too much and the RMD is not big enough to satisfy that, then one of the other things you can do is you can simply do an internal transfer. So you can take that money out of the IRA and move it into an after-tax account, which does trigger the taxes, but then that money can remain invested.
Talking with Jake Floyd of Floyd Financial Group, we're talking about some things that you should do in August, the 8th month of the year. Yes, there are only 4 more months to go. We've been talking about Roth conversions. We've been talking about what to do with your IRA. What are some of the other things that we want to consider that we might want to address here in the month of August, Jake?
Yeah, so a couple other things, Jeff. Checking your beneficiaries is always a good thing to do. Generally, with my clients, I check beneficiaries almost every time people come in, just because things happen, things change, people pass away, unfortunately, or people fall out of favor. Grandchildren are born, frankly. There's a lot of things that can happen. So checking beneficiaries, but also kind of reassessing your risk tolerance. This is something we've done a lot over the last year or so since Trump was reelected, where people had very little risk tolerance going into a potential Kamala presidency. But since then, people are categorically quite a bit more optimistic about the direction things are going. And so people want to make sure they're getting their fair share of the piece of what this market's been going up. And I think it will continue. It certainly won't be a straight line, but yeah, reassessing your risk tolerance, or maybe you don't like Trump, and maybe that would be a good reason to reassess as well, and you don't think things are going to go good. But always kind of staying on top of that and going, okay, am I allocated in the manner that I want to be allocated from a risk standpoint?
Well, Labor Day is less than a month away, and then people will begin to think about the holidays, of course, Thanksgiving and Christmas and New Year's. But right now in the month of August, this is a good time for some clear thinking. What are some of the other things, sort of a mid-year checkup, that you would suggest people do?
Yeah, depending on how close to retirement you are, one of the things that's good, as well as assessing risk tolerance, I think kind of looking at your overall goals as far as how much income you're looking to have in retirement, how much savings you need to have to make that a reality, kind of doing a checkup on where you're at. and whether you need to be saving a little bit more. If you got a good raise over the last few years and you haven't upped your contributions, you might want to consider doing that for the reasons we talked about previously, but also just if you don't get used to living on that money, when you get a raise, you can kind of scoot some of that money over to the savings account or to the 401k, and you never miss it because you didn't learn to live on it, And I think a lot of successful savers for retirement have done that over the years, and I think that's a good practice. Also, if you haven't looked at your will, powers of attorney, trust in a while, it might not hurt to take a peek at those things and make sure all the people are still in there. Sometimes I have people that have a 25-year-old trust that come in and they say, well, my brother and sister still get Jimmy if we pass away early, and Jimmy's now 45 years old, or whatever.
Right.
So some of those things could also potentially use airing out or updating, that kind of thing. But those are good practices to kind of look on. I don't know if you need to look at the trust every year, but if it's been a few years since you have, you might peek at that.
Well, as I've said many times in the program, Jake, time is a superpower. And right now you do have time without the distraction of the holidays to take a look at some of these things and make some changes if you think changes need to be made. Talking with Jake Floyd, Floyd Financial Group, and things that we want to tackle here in the month of August. Once again, if our conversation resonates with you, you want some advice, 417-889-7233 is our number. That's the number that you'll call to set yourself up with an appointment with Jake or Randy at Floyd Financial Group to talk about your journey towards a confident retirement. Again, totally complimentary, 417-889-7233. You can also do it online at floydfinancialgroup.com. Jake, let's take a break. We come back here on Show Me the Money. We'll be talking about risk tolerance versus risk capacity and how it changes as you get older when our program continues on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this last segment, we're going to be talking about how to handle risk in retirement.
And Jake, we've talked about this before, that your risk tolerance, your risk capacity may decrease as you get older, but still, even as you get older, there is some element of risk that you do want to take. So what is risk tolerance versus risk capacity? I've heard those terms thrown around a lot, but some people get those confused.
Yeah, so risk tolerance refers to your overall tolerance for risk, meaning how much risk you're comfortable taking. Risk capacity is really how much risk you should be taking or you can afford to take. And so some people have all the risk tolerance in the world, but they really shouldn't be taking risk because things are kind of tight. But sometimes I have people that aren't tolerant of risk at all, but could certainly afford to take all the risks that they want. And so those two things don't always align, and it's important to differentiate and to make sure that you have the desired outcomes that you've been looking for.
So your risk tolerance is really more emotional. Risk capacity, it's a little more analytical. If someone's risk tolerance is high, but their capacity is low, I would imagine that could spell some trouble.
Right. Yeah, it can. And that's one of the things that doesn't happen as often, but it does happen. And that's one of the things that I have to fight here sometimes, where I meet people that are like, it's all going to be fine. Well, assuming your timing is good, it'll all be fine. And so just really examining that. And a lot of that happens while I meet with people. I'm always thinking about these things, and it's not like an exam that you take or something like that. We're sitting here talking, and I ask some general questions, but I get a feel as we talk for your overall tolerance of risk and that kind of thing. And then obviously by analyzing your portfolio and that kind of thing, then I can get a feel for your overall risk capacity. So it's not something that you have to do the calculations on. It's more something that I'm going to be helping you out with.
Jake, as you get older, should your risk tolerance and risk capacity decrease? Or is there still some element of risk that you need to have in a portfolio in order to have some growth?
Yeah, so there are some people out there that don't want to have any risk. And if you've done a good job saving, then you're entitled to do just that. Most people need to have a little bit of risk in there simply because they need to make a better return than we can be guaranteed to have on savings. So we have to have a little bit of risk in there. Most people don't need to have a lot of risk, but some people like to take more risk because they like higher potential returns. Some people like to watch their portfolios in retirement and watch the numbers go up and down, and it's exciting to them. Now, I would say that's maybe 5% of people. That's not that many. Most people think it's scary if their stuff is moving around too much. But people like making money, and so again, a lot of the risk tolerance and risk capacity has already happened by the time I see people, meaning those things are set. And so what I have to do is manage the portfolio in a way where you're going to get the desired outcome. And that's the art of what I do. That's why I'm not too worried about getting replaced by AI just yet.
I hope not, Jake. I'm looking forward to talking to you on the radio for quite some time. Talking with Jake Floyd of Floyd Financial Group, we're talking about risk in retirement. When you're retired, Jake, you're no longer earning a paycheck. Obviously, you're living off your savings and your investments and fixed income sources like Social Security or pensions. That means if the market takes a big dip early in retirement, you can seriously jeopardize your income. We call that sequence of return risk. Can you expand a little bit more on sequence of return risk, why it is a problem for people, and how we could possibly combat that?
Yeah, so sequence of returns risk is just saying that not all 6% returns over 30 years are created equal, meaning if I have a 6% return and over 30 years, and it comes in like 20% in the first year and then 10% in the second year and 25% in the third year, but then on the back end of the 30 years, it's a lower return. That outcome is going to be much better when I'm taking money out in retirement than the opposite, where we have negative years in the beginning and better years later. If we're not taking any money out, those returns are the same and the outcome is the same. But once we start taking money out, we're sensitive to the fact that having bad years right up front as we start taking money out can negatively impact the overall portfolio in retirement. So having some safety valves in place to prevent large drawdowns in your retirement savings are generally a good idea. And that's why when you're saving and you're accumulating money for retirement, having a buy and hold approach is not necessarily a problem. You put the money in there and you keep funding it, whether it's good or bad, and you can afford to wait for it to come back if we have a 2008 scenario, and then, it does come back and you have a little bit higher returns. But once you get ready to pull the trigger, like the last 5 years before retirement and then in retirement, we need to start having some kind of safety valves in place, because we can't afford to have a 2008 scenario on the year you're going to retire. Because if that happens, you're likely either going to have to go back to work or delay retirement, that kind of thing. But if we set the plan up right, you can weather just about any storm.
Jake, I know here at Floyd Financial Group that you meet with a lot of couples, a lot of married spouses. Do you find that risk capacity, or rather risk tolerance, is quite a bit different between genders?
So I wouldn't say that it's actually the male versus female. I would say that most couples have somebody that's very comfortable with risk and one that is not so comfortable with risk. I'd say it's pretty rare that they align on risk tolerance. But I have lots of gals out there that are ready to roll the dice, and lots of guys that are a little more conservative, even though you think it would be the other way around. So I wouldn't say that it's so much a gender-specific thing. It's more a just realizing that you don't necessarily have the same risk tolerance. And, if I have a guy that's really big on risk and a gal that's not, a lot of times we're going to play a little bit toward her hand, because happy wife, happy life, right? If she's awake all night wringing her hands, that's not good for his sleep schedule either. And so finding a balance there sometimes is the best approach.
And I think it's important to have both spouses present during these meetings. And Randy tells the story of a man that he talked to, and the woman really didn't say too much. And he finally said, "Now, I want you to be quiet for a moment. I want to talk to your wife." Ask her, "What do you think?" She says, "I think he's crazy." And it really came out as to, exactly what her view on risk was. So it's important to come to a meeting of minds as far as risk goes. How do you help clients who want to take more risk emotionally, but they just can't afford it? They do not have the risk capacity. How do you sort of reel them in a little bit? Do you really put this out on a whiteboard? Do you stress test things? How does it work?
Yeah, so when we're looking at risk tolerance, yes, there's some stress testing that we do, but really we need to have some money that we know we can count on. And if the market is going to give us a negative 50% or something in a 2008, the big thing that we need to do is not take a 50% loss or something in retirement. Because if we're pulling out, let's say 5% in income, and then we have a 50% loss in the portfolio, now we're taking 10% out in income, which is way, way too much. So the goal is to be able to recover from any downside that we would get. And a lot of that has to do with how much money you saved, how much money we're requiring each month off the investments. And so that will set up the boundaries and the perimeter, if you will, for what we can do from a capacity standpoint. And then the tolerance standpoint is more a personal preference of and comfort level of the people that I'm talking to.
Jake, is there any point in the retirement journey? You know, a lot of people that we're talking to here may be 60, 65 years of age, but let's say that we have some listeners who are 75 to 80 years of age. They're hearing the program today. They're worried about risk. They don't want to take any risk. Is that ever an acceptable way to go? No risk at all?
I would say most people do not fit the category where they should be there. I do have people, though. I have one gentleman that comes to mind that came to see me. He's like 86 years old, and he has all the income he needs. He's got a few $100,000 in investable assets, but he just doesn't want to have to worry about what the market's doing. You know, he doesn't need the money. He's going to pass it on. And so he's like, hey, I'm going to do fixed annuities and CDs and savings accounts from here on out. And I think that's totally fine. I would say he's the exception, though, because most people need their money to earn something so they don't spend it all down to zero. But if you have a really good retirement income with a pension or military disability or whatever it may be, you may be in the boat where you don't need the money. And then, yeah, you don't really have to have it at risk if you don't want to. But I would say the 95% where they really need their money in retirement, we want to utilize the United States stock market because it's the greatest wealth creation engine in the history of mankind, and it can help you through retirement.
Jake, we've talked about the 5 things that money can actually do for you. Those include cash flow, security, growth, liquidity, and tax savings. Are security and growth, let's say, opposite ends of the magnet, totally diametrically opposed?
No, not necessarily. I would say that the 3 that I like to focus on is growth, safety, and liquidity. So you can't have all 3 of those things. You can have 2 of the 3, but you can't have all 3 of those things in one investment. And that's why we usually have multiple different investments that we're using, because the stock market, for example, is very good at growing money. It's very good at liquidity, but it kind of sucks at safety, right? You're just at the mercy of what's happening in the moment. But there are products out there and accounts that are good at growing in safety, but you give up liquidity to get that. Or if you want your money just sitting in the bank or in the mattress, it's good at safety and liquidity, but it's not going to grow, right? So we don't generally advise those things, right? But if we can blend a few investments together to give you enough liquidity and enough safety, but have everything focused on growing money, that's kind of what we like to do.
Talking with Jake Floyd, Floyd Financial Group. We're talking about risk tolerance versus risk capacity. Jake, let's wrap it all up here. Any final advice for our listeners about risk tolerance and capacity as they get ready to retire or continue into their retirement?
Yeah, I would say that for all the recorded history of the stock market, it pays to be invested. Even in the moments where it seems very difficult to be invested, 5 years later, 10 years later, you would have been very glad that you stayed the course. And in our earlier segments, we talked about AI. In this segment, we're talking about risk tolerance, risk capacity. I would just say that make sure your risk tolerance matches what you're comfortable with, and then don't deviate from that. You know, some people have what I like to call risk tolerance drift, meaning when things are really good, their risk tolerance skyrockets and they want to know why they're not in the most risky things imaginable. But as soon as there's any kind of opposition, they want to go all the way back the other way, right? Be honest with yourself about risk tolerance and risk capacity, and you won't be jumping in and out and costing yourself money. And I really think over the next few years here, it's going to really pay to be invested. It doesn't necessarily need to be even in the stock market. We can talk about different types of investments, but you're going to want to not be in cash, in my opinion, over the next 10 years for sure.
Jake, I would say to our listeners hearing this program today that if you have questions about risk tolerance, you're not having these sort of conversations with your current financial advisor, we would invite you to give us a call here at Floyd Financial Group so you can have a casual conversation with Jake and or Randy right here in our office in downtown Springfield. 417-889-7233 is our telephone number. It's 417-889-7233. It's totally complimentary, not going to cost you a dime. There is no judgment. So make that call right now at 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, we're out of time for this week. I want to thank you so much for your time, but most importantly, I want to thank the greatest listeners in the world, ours, right here in the last bastion of sanity, Springfield, Missouri. So for Jake Floyd, I'm Jeff Shade. Have a great weekend. We'll talk again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk. The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.